This video is going to review the prep work, how we handle the worksheet, and how we prepare the balance sheet for the date of acquisition. Here's the information. A parent's purchased 100% of a sub. By the way, it's helpful if you have this practice problem in front of you so you can stop the video and work along. So the parent has purchased 100% of a subsidiary on 1/1A, paying $1.8 million. And the company has also discovered that the sub has two understated assets. A building that, comparing book value to fair market value, is understated by $230,000. That's got a 10-year life, and a patent that isn't on the books but has a fair market value of $180,000 and a 5-year life. It goes on to say all the other assets and liabilities have a book value equal to their market value, and then asks us to prepare the prep worksheet and the balance sheet. And notice here that it says the worksheet we're going to prepare will be on 1/1A immediately after acquisition. So that means this $1.8 million equity investment is already included in our accounts for the worksheet. And you can double check that by going down here and seeing that the equity investment does indeed have a $1.8 million equity investment. First thing we're going to do, even though it's not necessary really at the acquisition date entries, for the acquisition date entries, is prepare our table to show the impact of these two overstated items. And I'm going to use the 2-column per year approach. So for the building, we start out with adding 230. In that first year, it will be add amortization of depreciation of $223,000 rather. As we use that asset up year after year, the balance that we need to worry about goes down. For the patent, it started out with $180,000. This is 180 divided by 5. So that's the expensing of that patent that we need to do in the first year. Here's 144, our balance, additional expensing, etc. The next thing we need to do is calculate goodwill. And you can really do these in either order, but I think it's a little bit helpful to have thought through what the impact is going to be of the fair market value versus book value. So here's our calculation. Here's the price paid. And I got the book value of the sub by going down here. Ignore these. I think I'm going to just black this out for a minute so that we're not distracted. So I go down here and I look at our worksheet. We have common stock, additional paid-in capital, and retained earnings. That's the equivalent of the net assets, assets minus liabilities. So going back to our calculation, that is the book value of our net assets. That leaves us with an excess of $775,000. Now, the parent paid extra, so one reason is that that building really was worth more. So I'm going to subtract that because that explains some of the excess. Then the patent also is another reason why you might pay more than book value. So I'm going to subtract that, and that leaves us with goodwill. So there you go. There's our final goodwill. Now we need to make the journal entries, and you'll see that eventually we're going to have a C entry that we will make later on in the after the first year, or at the end of the first year. But we will always have an elimination of equity entry. Here's that entry. Again, I take these numbers right off our worksheet. They're credits, balances in shareholders' equity. I need to eliminate them, so I'm going to debit them and eliminate an equivalent amount from the equity income. In addition to paying for that book value, the company also paid for the following things. And this is the R, or revalue, entry. The additional equity investment was paid so that we could cover the fair market value of that building, that patent that wasn't on the books, and the rest is goodwill. Again, that explains the rest of the equity income. We're trying to, equity investment. We're trying to eliminate that off our books so we don't have double counting. Now let's go and see what the impact is on our worksheet. So I take this first entry and I just post the debits and the credits. Just to remind you, there we go, debits and credits. So here is the common stock, the additional paid in capital, the retained earnings from the sub. They're not being permanently eliminated, just for purposes of this consolidation. And here is the amount of that equity investment that was paid for the book value. Now we're going to take these entries. Here's the increase in the building. Here's the increase in the patent. This should be goodwill. And here are the totals. So now I have increased all of the assets and liabilities so that they have equaled their book value, and I've eliminated the amount of the investment that was due to that increase or decrease in those assets. So I basically just posted these two journal entries. Now I add across. So this is our consolidation column. Here's the parent, here's the sub. That gives us our total. Since these all have normal balances of a debit, we add the debit column, we subtract anything in the credit column, and we get our final balance. Remember that for the equity investment, that's a debit. We're going to take off everything that was added or subtracted to that account so that we can just consolidate the actual effects. So we know we've done okay because that turns out to be 0. Add and subtract across. Here's our new building at fair market value, building account. Here is the patents at fair market value and goodwill. Finally, here's the total assets. We do the same thing to the liability. The most important thing so far is that by crediting and debiting all of the subs shareholders' equity accounts, we've eliminated them, and we end up basically with the shareholders' equity of the parent. Double check that our assets equal our liabilities, and then you can make a balance sheet.